Welcome to Eureeca.com. This video is to assist you in creating a viable financial forecast for your company. You may find it useful to have a pen and paper ready to take notes, and please feel free to stop, pause, or rewind at any time. Financial forecasts. What are they? Financial forecasts are a set of financial statements predicting future outcomes. They give potential investors an idea of what the business will look like. Financial forecasts are more of an art than a science. That's because hard numbers are extremely difficult to provide accurately. The numbers should be challenging, yet reasonable and achievable. You need to tell your investors a story. An experienced investor will not expect your forecasts to be 100% accurate. More important is what they say about the economics of your business. You need to tell a story of opportunity, growth, and profits. Guy Kawasaki writes, "The goal is to tell a credible as well as exciting story about what your business could become." For helpful software, why not visit easynumbers.com? Eureeca has partnered with easynumbers.com to provide you with very affordable forecasting modelling software. Please contact us for your discount code. So, how do you come up with a decent set of financial forecasts? Before you begin, you need to know the target market size, customer buying habits, and competition. You will also need a set of financial statements. For example, an income statement, balance sheet, and statement of cash flow. Expectations. You'll need to provide the short-term, medium-term, and long-term forecasts for your company. The short-term is a 1-year forecast broken down by month. The medium-term is a 3-year forecast broken down by year, and the long-term is a 5-year forecast also broken down by year. You'll need the best case scenario, base case scenario, and also the worst case scenario. It's time for a sanity check. Remember, your numbers need to make sense. Does the amount of funds you asked for match the capital requirements presented in your forecasts? Have you calculated the number of customers you need in order to generate the revenue streams you projected? Have you studied your customer base thoroughly enough? Do you know the time and costs required to acquire and retain those customers? Are you aware of the costs of competing with existing substitute products? And are those costs reasonable? Martin Zwilling, a veteran startup builder, provided the following tips in his Business Insider article. Start with sizing per unit profitability. Margin is everything. Unless your volumes are in the millions or higher, the difference between manufacturing cost and customer price better be 50% or greater. Otherwise, sales, marketing, and operational costs will kill you. Next comes sales volume by channel. Here is where you need a bottoms-up estimate from the people in your organization who have to deliver. This forecast is really their commitment. It's tempting here to simply calculate 1% market share and assume anyone can do at least that much. It's not credible and it won't happen. Don't forget that pesky overhead. Even with the economic downturn, it's amazing how fast office space costs add up, in conjunction with insurance, utilities, and administrative help. Then there are computer costs, trade shows, inventory, and 1,000 other things. Check industry average statistics to make sure you are in the right range. Cash flow is king. Your burn rate or net cash flow out is usually the single most important survival parameter to a startup. The holy grail is break even, when revenues first catch up with the outflow. Projecting, tracking, and controlling cash flow is the single most important job of the CEO and all other startup officers. Add a buffer to your required investment. Calculate what you need based on the cash flow calculations above. See where your cash flow bottoms out. If the bottom is minus $400,000, add a 25% buffer and ask for $500,000 funding. The request size must correlate to your projections to be credible. So remember, most importantly, forecasts are meant to provide a rough idea of what you imagine your company will look like a few years down the line. Be bold, yet keep it achievable.